They were doing exceptionally well until about a month or so ago. I like insurance. I see this as a bit of a success story.
I definitely won't be buying more of it, but I don't know, would I be considering selling it at the minute, you know? How's it going, everyone? Welcome back to another episode of the Investment Hound podcast. Before we get started, there are two things that we need to discuss really quickly. If you haven't already gotten yourself a copy of Grandad's new book, Successful Investing: How to Make Money in the Stock Market from Real Life Experience, make sure you go and grab yourself a copy after this video. The second thing is, make sure you go and follow us on social media, on TikTok and Instagram at The Investment Hound. So for those of us that have been keeping up to date with what we've been doing here on The Investment Hound, you'll know that Grandad and I are building our own portfolio using all of the information that we discussed in the very first few episodes of this podcast, and also the information from Grandad's book as well. So where are we now within this process? Well, we have made a portfolio of 20 different shares. Grandad has picked 10 and I've picked 10. And now the challenge is what do we do with this portfolio? What shares do we cut? What do we add more to? And what are the different weightings per sector? So within this episode, what we're going to be looking at is the shares broken down per sector, where we'll be identifying which ones are overweight and which ones are underweight, and then what do we do going forward. So to get started, Grandad and I have built Grandad built the Excel spreadsheet, and then I sort of added the live prices into the Excel spreadsheet. But we won't be going through the spreadsheet in detail within this episode. That will be in the coming episodes, because what we need to do now is we need to decide which sectors are over and underweight, and put the shares based on the sectors which are over or underweight onto our watch list. So where are we currently sitting with our portfolio? Well, it's actually doing very, very well. So as we can see from this column here where my mouse is, the portfolio is up 4.29%. So we invested a mock 96,700 euro, and the live valuation is over just slightly over 100,000 euro, which means that we have profited 3,865 euro over the past 12 weeks of unrealized gains. What's your take on that, Grandad?
Well, I think we need to look and see the winners and the losers.
Yeah, because there definitely are some big winners and some big losers.
Well, it's easy enough to pick out the losers because they're in red. Do you want to go through those?
Sure. I keep flicking the screen back the wrong way. Okay. So again, we will be going through this Excel spreadsheet in more detail in the coming episodes and showing you how we made it. Before the minute, we can look at the big losers highlighted in red here. Our big losers, first one is Whitehaven Coal Limited, down 25, nearly 26%. The second is Adecco, down nearly 20%. We have a little loser here, National Australia Bank, down 5. We also have EDP, EDP, down nearly 6%. That's a minor one there. And then we have Tesla down 15% and Amazon down 1%. Then our big winners we have Banco Santander up 30%. We have CVS Health Corporation up 15%. We have Total Energies up 11%. We have Ryanair up nearly 20%. We have Sunoco up at 21.5%. We also have Verizon up 10%. Another big winner would be BASF SE up 15%. We also have MasterCard up 7%. And Emera up 7% as well. And then a couple other ones as well, up ever so slightly. So overall, the portfolio is actually doing quite well. The ones that the majority of them are up. And the ones...
Well, there's a number of lessons I would take from it. Okay? Well, they talk about the Magnificent Seven, which is the technology-driven type shares, Now, there's more than technology in it. But they were doing exceptionally well until about a month or so ago, maybe 6 weeks ago. So that accounts for Tesla, for example, which is a big last one for us, right?
Yeah.
Now, if we look at Adecco,
Yep.
Adecco is a recruitment company. Now, other recruitment companies have done better than Adecco. Adecco is Swiss, but it operates internationally. And the question really is, has it got a future? Okay. In other words, we're almost at full employment. So how can it grow much faster than it is growing? And in fact, what it's done, it's come down by 20%. Now, so that'd be a worrisome one for me. So Tesla and Adecco will be the ones I'd worry about. Whitehaven Coal is also down, and I don't know why that should be down, but it is getting worse all the time. So that's another one I would look at.
Yeah.
The other ones are kind of 4 and 5%, EDP and National Australia Bank. So I'd be a bit more relaxed about those. And certainly Amazon down 1%, terribly relaxed. Then looking at the winners, Santander has been a fantastic winner. So really the question is, should you take some money off the table when it's a winner? You know, in other words, if it's a winner, should you take some of your money away and then be playing with more of other people's money? In other words, is it time to cash in something there? It's very hard to cash in when it's going so well, but nothing goes so well all the time. So it's at 30%, which is quite a high one. Sunoco is at 20, which is another high one. And then you have CVS Health is 15. And almost, and BASF is almost 15. So would you be doing something on those ones? So that's just sort of my reaction to looking at it overall. But also, I think we're very pleased that we're 4% up. And because we built this over the last 6 months.
Yeah.
So it's not as if it was maturing there, and now the summer has arrived. Now, we were buying them throughout those months, and so some of them are on the way to actually be winners, and some of them are clear winners. It's quite a good performance, 4% in effectively 6 months. So then you wonder if, in fact, the wheels are now going to come off because we've done so well, or whether the wheels will continue. So they're my reaction to it. What's your reaction to it?
Well, let's go through it, each one. Now, within this decision, for the listeners, we won't be looking at the technicals. The technicals will be in the coming episodes when we go through the spreadsheet. So at the minute, all we're looking at is the change and the weighting. So as we can see on the screen here, we have the change
in the sector weighting.
Yeah. Okay. Let's dive into what my inexperienced opinion is. So the first one we have is aviation, which is Ryanair, a good old Irish company. And their live price at the minute is €2,836. And the change since when we bought it has been very good. One of our strongest ones, and it's up 19, nearly 20%. But the weighting of our portfolio for Ryanair is only 2.82%. So I know there's a general rule of thumb, Grandad, which is 5% per share and like 20% per sector, roughly, isn't it?
5,000 per share. Well, if it's 5,000 per share and say 10% per sector.
Yeah, it's definitely underweight at 2.83%. Yeah. But it has made significant gains. So I don't know, would I be considering, I definitely won't be buying more of it, but I don't know, would I be considering selling it at the minute, you know?
Well, I like it.
Yeah.
They are a company. They're the biggest company, short flight company in Europe. And if we're coming from the extreme western edge of Europe, they have been a marvelously managed company. Now, their chief executive, Michael O'Leary, is about 62 or 63. So he may step down, but until he steps down, I think he's running a good show, and I would invest in him. And I would invest in their model. They have a clear competitive advantage over other airlines. They run everything very cheaply and very successfully. I'm a friend of mine that used to work with me. Went off and he did a flying license or whatever you call it, pilot's license when he was in his early 50s. And then he joined Ryanair. And he told me that where Ryanair was concerned at that time, and this is 20 odd years ago, he said the plane could not remain on the tarmac for more than 45 minutes. And your job as pilot and all the crew and all the people around was to make sure that Ryanair got their flights off within the 35 minutes. And so they brought all sorts of rules and regulations in. They were the first to charge for luggage, and everybody said, oh my God, why would you go to Ryanair? They're going to charge you for luggage. But it was only a matter of a short period of time before all the other airlines started to charge for luggage. Yep. They are the leading light, in my view, in what they do. And, if we're 20% up, the question is, are we buying high? And I don't think so, because I think the current share price, can you tell me what the current share price is? The current share price is 16, 17, isn't it?
No, that's the purchase price. 20 euro 26.
Well, I've seen it higher in the past. Yeah. And if you believe that we're heading for a recession, I wouldn't invest in it. But I'm not sure we're heading for a recession. Interest rates are coming down. That's going to help everybody, So I'd go in. It'd be one that I'd be of a mind to go in. But I'd like to see what the technicals show over and above that. But my starting position would be, it's a success, it's underweight, why wouldn't I go in more?
Interesting. Okay, I wouldn't have taken that opinion.
But that's what makes this podcast so interesting.
I know, I'm not disagreeing with you, I'm just making
You remind me of my wife who has never agreed with anything me in 54 years of marriage.
Okay, that's an interesting opinion. I wouldn't have thought of it that way. I would have thought of it, it's doing well. Let it be. Wait till it hits that sort of 30% threshold.
Yeah.
Okay, let's move on then. So the next one here on the screen we have is the services sector, which is Adecco Group Incorporated. Not one of our rising stars.
No. It's one that you'd certainly have to say, it's lousy share.
Yeah.
And there's no reason to believe it's going to turn into a prince or a princess in the next 6 or 8 months.
Yeah.
So the only question is, would you take the hit or hope for something better? And I'm of a mind, if I had that 4,000 stuck into Ryanair, for example, I might be happier.
Yeah, definitely. Well,
and by the way, that means that the 19.83% is paid for by the 19.67. You know what I mean? In other words, we're actually we're using a loss by we're putting it in and averaging Ryanair. I'd be of a mind without looking at the technicalities, but I'd be thinking that's one that we should have on the watch list. I agree with you.
Definitely, I would definitely stick it on the watch list. The sector is also underweight with only 4% of the weighting of portfolio as well. Okay, let's move on. The next one we have is Amazon in our consumer discretionary sector. And Amazon I forgot to change this color here, but it doesn't matter. Amazon are experiencing a minor loss of 1.08%. And they currently are weighting about 5% of our portfolio. So I think the weighting is fine, and I think the loss is fine. So I would leave it be. What's your take on it, Grundy?
Well, first of all, it doesn't pay a dividend. Okay, so I don't like shares that don't pay a dividend, right? Secondly, the fact that it's down by 1% is irrelevant.
Yep.
Shares are going to go up and down by 5, even up close to 10%. You wouldn't worry about it one way or the other, right? Thirdly, they seem to have a very good business model, and I think they'll grow over time. but they are one of the big Magnificent Sevens that seem to have paused. I think the American investors have got out of investing in these big Magnificent Sevens and have started to put money into Europe on the basis that Europe eventually will get its act together. Good luck with that, lads, but we won't object. So I'm not worried about that one. Are you worried about it?
No, I would let it be. I like Amazon as a company, so I would leave it be. Okay, moving on. We have our telecom sector. Verizon. They're experiencing a minimal growth of 3.3%, and the sector weight is evenly balanced at about 5.08%. So I'm happy enough with it, Grandad. What's your take?
Well, I bought it probably 2 or 3 years ago, and it's only in the last 2 weeks that it's become profitable.
Oh,
so I might be tempted to get out of it.
okay.
However, what's it? I'd have to look at the technicalities, but I would certainly leave it there for the moment for a review.
Yeah. Okay. Okay, that's interesting. I wouldn't have stuck it on the watch list, but I suppose you would. Okay, next then we have the technology sector. And in it we have Alphabet, so Google's parent company. They've experienced a minimal loss as well of just under 1%, and the sector weight is even...
That's them just rebalancing, the American investors rebalancing into Europe. So I wouldn't worry about that one.
Yeah, neither would I.
I think it's a very good company.
So do I. And I like their outlook for the future as
And
well.
my
A lot of
niece
AI investment.
My niece and goddaughter works for them in Seattle.
Yeah. Okay, moving on. We have FinTech, which is MasterCard Incorporated. MasterCard have experienced a nice gain of 7%, and the company is evenly balanced within the sector of 5%. So I think it's fine.
Yeah, the question is, would you add to it?
Well, I don't think there's any blood in the streets.
No, there's no blood in the streets. I mean, it's doing well.
Yeah.
And I wouldn't have bought it, but you insisted in buying it and you've been proven right. It's doing well. Now, I don't think it pays much of an old dividend, does it?
No, I don't think it does. I thought it was a better percent.
Well, the technicalities might change my mind, but at the moment, it's nice to be ahead.
Definitely is. Okay, next we have one of Grandad's picks, insurance, Legal & General. I think it was one of the last ones we did. We have small minimal gain of 4.25%, and the company is balanced within its sectors of 6.5%, so I would leave it.
I like insurance.
You were very keen on this one when we did the podcast on it.
Well, yeah, and we did it about 4 weeks ago, and we're up 4% already.
Yeah.
Remember, I said to you it's going to improve.
You did?
And I think it will. I like insurance. I see this as a bit of a success story. Happy to have people genuflect in front of me on that basis.
Super. If you haven't seen that episode, make sure you go and check it out. It was only one that was a couple of weeks ago. Okay, now we move into a sector with two companies. We have the materials sector, where we have BASF SE, who have done nicely. They're up 14%, and the company is balanced in the sector of just under 6% weighting. Next, we have a not so nice one of Whitehaven Coal Limited, who are down 25, nearly 26%, and are slightly underbalanced in their sector of 3.31%. So here, my take would be definitely stick Whitehaven Coal on the watch list to do something with, whether it's to add more to or to...
Now, the only thing about BASF, if I can say it to you, right, and you'll see it when you come to the technicalities, BASF are paying, I think it's a 9% dividend. If you take the dividend they paid last year and express this as a percentage of the current share price, it's 9%, okay?
Yeah.
But they have refused to state what the dividend is going to be this year.
Okay.
So I'd leave that on the watch list to see what they're saying. But that will come out of the technicalities one. Whitehaven, what are we doing in it? I don't know.
Yeah, I think that was the first one I picked.
We're lucky there's only 3,300 left.
Yeah. That was the first one I picked, wasn't it?
The
Whitehaven?
problem with Australia,
I think it was.
is a lot of our Australian shares are a little bit disappointing. And I don't know why that should be. Because I was looking for diversification by going to Australia.
Maybe something to do with tariff threats.
With what?
Tariff threats.
With what?
Tariff threats. Australia would have a big export market.
Yeah, but they have raw materials, and people need raw materials.
Yeah, definitely one will stick on the watch list to look into anyways.
I'd stick to two of them on the watch list.
Okay. See, I was under the impression, Grandad, right? 35% is a definite sell, at least of the initial investment or profits or whatever.
Yeah.
I didn't know about 15%, because a couple of my shares in my personal portfolio are at 15% and I'm sort of waiting around. But maybe I should reconsider my judgment.
Well, you need to be diversified. That's the key.
Yeah.
Yeah. In the book, I show that I invested 200,000 and I normally invest 5,000 in a share. So that actually would be 2.5%. And I allow, I'm comfortable with going to 10. But when it goes to 15, I have to have very strong reasons to leave it in there.
Okay.
Which 15 would be 7.5%, So 10% definitely, is high. If you've got 20 shares, if you're allowing everybody to be at 10%, it means you only can have 10 shares, for your 100,000 that you've invested. So I must say, I think, I worry a little bit about shares that have more than 10% of the portfolio.
Okay. Moving on, we have our autos sector. We have two interesting ones here. We have Tesla Incorporated, not a rising star, a losing star in my opinion. They're down 14.42%, and I can't really see them going any higher than they were when we put them in the portfolio. So that would be one that I wouldn't be keen on buying when there's blood in the streets. I think that there's going to be more and more and more and more and more blood. So.
See, I think the Americans believe that Elon Musk is an absolute genius, and they've pushed the share price up way above and the technicalities will show you, way above their PE ratio is way above what's normal.
Yeah.
And you see, when he started building those electric cars, he definitely had a competitive edge over all the other auto companies. Mm-hmm. But they're catching up by the day.
Yeah.
And therefore, what's going to keep that PE ratio up at such a high ratio? I'd be of the view that there's no good news in Tesla.
Yeah. A lot of I suppose the media say that it's like they have like a cult investment or a cult group of investors who are just diehard Tesla / Elon Musk fans, and they'll just be with him to the end. But of course, the earnings have to back up the price earnings ratio, don't they, and the share price?
Yeah, and I mean, I suppose what I'm saying too is I think the Tesla advantage, the competitive advantage that they have, is gone. Now, he's talking about doing new things. But for example, I know that the Chinese recently introduced a huge amount of driver aids into their cars, and they're not charging anything extra for it. Mm. So the risk here is that China can produce what Tesla want to produce in the future, and that they can produce it more cheaply. So I think there's a huge risk around Tesla.
Yeah, I would agree. It was great for views on the podcast, but not good for the portfolio. The next one then we have is Volkswagen. So we have Volkswagen are doing well. They're up at 10% or 9%, and the balance is fine for the portfolio. So I would be of the and they do what is it going? Is it 9.5% dividend or something like that? So I would be in
But
favor.
let me talk to you about the dividend. Okay. Again, when you look at the technicalities, because I have that share. Okay. When you look at the technicalities, you'll see they're refusing to say what the dividend will be this year. They went to the unions. Now, first of all, the unions in Germany in the car business are very interesting. Half the directors, I think, on the board, supervisory board of car companies in Germany are union officials, right? They have huge say on what goes on in a company. So Volkswagen are doing very badly. They're very modestly priced, but they're doing very badly because the electrics that went into, people have stopped buying electric cars in Germany and across the world, okay? And they also, people are actually not buying as many cars in places like Germany where there's a recession. And they haven't had any growth rate in their economy for 2 years. And Volkswagen's single biggest external customer was China. And China's going through difficulties as well. So Volkswagen decided that they would cut production levels. Now, are you going to cut production levels in the factories that cost the most to produce cars, or in your factories that cost the least to produce cars? Well, Volkswagen took the view that the cars being produced in Germany are very expensive because the German salaries and wages are way higher than they are, say, in China or Mexico or whatever, right? So they went to the unions and they said to the unions, we want to close down the 2 German factories, which are huge in Germany, right? And they were told to get lost by the union. So now what's happening is there's a voluntary kind of redundancy. If people want to go, they'll be allowed to go, and on favorable terms, rather than closing down factories. So Volkswagen are hoping that in time they'll be able to close those factories down because people will find they're not getting pay increases and they're getting good incentives to leave. That's all going to take time. So what Volkswagen have said is, we don't know what kind of a dividend we're going to pay this year. They're a very uncertain company. The question is, would you hold on to them? Now, they're modestly priced. When you look at what companies are priced, generally speaking, on the German stock market, Volkswagen is very modestly priced. So you might stay in and give them a shot at it. On the other hand, you might actually say, let's get the hell out, we're ahead. So let's see what the technicalities say on Volkswagen.
Yeah. Interesting. Okay. Moving on. We have the utilities, where we have EDP, and who are slightly down at about 5.5%.
Well, they're a Portuguese energy company. Now, the thing about those kinds of companies is they're all heavily regulated in Europe. They go to the local regulatory body and they say to the local regulatory body, we need to pay so much, we need a price increase to pay for the switching to wind. We need a price increase to pay for the maintenance of our factories and so on and so forth. And so they kind of agree a price increase with their regulator. And the regulator usually gives them a generous price increase that will enable them to raise money for new businesses. And yet, I had been in EDP and I made a lot of money out of it. And I went back into EDP and I'm losing money in it. So I don't understand EDP, why we should be losing money if in fact they're agreeing, if you like, the price increases with their regulator. Is the regulator now attacking them, or I don't understand what's going on there. I'm sorry I'm in them because I'm losing money in them. And I can't understand why I'm losing money, because I would have thought that energy companies should be doing well.
Granted, I'm in the exact same boat as you. I'm also in EDP, and I think I'm down maybe I think it's actually about 5-6%. I think that's my price that's put in.
Yeah.
And it was
Now,
a
the
mistake.
big news there, however, is they say they're going to pay a very significant increase in the dividend next year. Like the dividend is, let's say the dividend is 3%. I think when we look at it in the next podcast, you'll find the dividend could be 5 or 6%. You know, it's going to almost double. It's going to be 40% up or something. Do you know what I mean? So effectively, that's leaving me in there, you know, to see if that happens.
I'm just waiting until they go positive. Then I'm going to get out. I don't really like the outlook of the company. So.
Yeah.
Next, we have a very good one, though. We have Sunoco, who are up 20.5%, which is amazing, and are weighing about 6% of our portfolio. And I think that's a good one, isn't it?
It's done very well, you know, and I think, you know, certainly one I'd stay in. Yeah. And, you know, at some stage, we'll have to look at it and see whether we'd cash in the money or increase our shares in it.
Moving on, then, we have our banking sector, which has our biggest win. Our star share in our portfolio, we have Banco Santander, up 30.7%, weighing about 6.5% of our portfolio. Excellent. That was only a recent rapid growth as well. I remember seeing that on Bloomberg one morning, that Banco Santander. I don't know. I can't remember what happened, Grandad. I'm sure you do.
They've just had very good earnings. The thing about Banco Santander is it's a Spanish company, but it has significant business in Central and Southern America. So it's actually quite diversified. It makes it riskier because you never know what the Mexicans are going to do, sort of thing, you know. Yeah. But obviously, what's going on there at the moment is driving the share price up because they like it, you know. Yeah. Now the European bank setup is not as favourable going forward because the ECB, which is the European Central Bank, are talking about lowering interest rates, and when interest rates are being lowered, it affects the net interest margins of banks. One thing that has slightly worried me about them is they haven't yet indicated what they were talking about paying a nice fat dividend, and suddenly it came up and said we have no knowledge on what the dividend will be. So I'm just a little bit concerned, but I'm watching it like a hawk. I'd leave it on the watch list, I must say.
Yeah, I would definitely stick it on the watch list as well.
But it's been very successful.
It has. And, you know, I don't think it's a bad thing as well to be diversified into, you know, Southern America. Like Brazil is one of the biggest emerging economies. So
yeah. I'm not sure if they're in Brazil. Brazil speak Portuguese, you know that?
Yeah.
You picked the wrong country.
Well, no, but I mean, they're part of the BRICS, you know, what is it, Brazil, Russia, India.
Yeah.
So.
I'd say this crowd are more in Chile and Argentina and places like that, you know.
Yeah, well, it's a great one anyways for our portfolio. I would also stick it on the watch list. Next, we have National Australia Bank, down, 5% and weighing about 4.5%.
Just again, like the other Australian bank, Australian share we looked at earlier.
Yeah.
Extraordinary, isn't it?
Yeah, interesting. I don't know. I must do a bit of research in what's going on there.
It might be to do with the currency. I don't know. But they're both down anyway.
Yeah, but I would leave that anyways. 5% is fine. It's not a threat. Okay, moving on then. We have two good ones. We have Bristol Myers Squibb, up 9.5%, weighing 5.7% of our portfolio. I think that's good. I like it.
You see, the way I look at pharma, Adam, is this, right? Pharma, what happens, the pharma companies, what they do is they buy promising drugs before they're fully issued, before they've got the permissions and so on. But they look as if they're going to be winners. So what the big pharma companies do is they crawl around the place or trawl around the place, right? Until they find companies that they think have drugs that might be winners. Okay? And then they're winners for a while. But then they lose their patent protection. Okay?
Yeah.
And then the share price takes a dive. until they find the next 2 or 3 winners. You know what I mean?
Yeah.
So I had Bristol Myers Squibb for a while, and it was underwater. And then suddenly in the last month or two, it's over water. So they've obviously now got drugs that the market now believes in. So I think that's a good one.
Yeah, definitely. I had Bristol Myers Squibb. I sold it recently, actually. I remember I sold it definitely for a profit.
Yeah.
My reason for selling it was because I actually took a lot of influence from the analysts. I know the analysts didn't have a good price outlook for the coming 12 months. And I was like, well, do you know what? It's at a profit now, and I don't really want to take that risk, so I sold it. I can't remember how much I made off. I think it was only a tiny bit anyways if it was in my portfolio, but it was good. Next, we have another one I hold, which I'm very proud of.
This is one that you chose. This was one you chose.
Yeah, and one I bought at the same time as well. I was very proud of it. They were actually, so they're up 14, or just under 15%, and are
they took their time getting there too.
Absolutely. And, they were up 20% during the week as well. And only over the past few days, they're after dropping down to 14.
That's actually 15%,
Yeah. 15. Yeah. Same with a lot of the other American ones. I saw over the weekend anyways, the Dow Jones took a massive hit, just under 2% of a hit over the weekend, just because...
I think a lot of American investors are nervous of what Donald Trump's initiatives will do. Will it be positive or negative? They're not sure.
Yeah.
So a lot of them are pulling out, and moving into the cheaper markets like the European market, which helps us.
It definitely does. Well, CVS jumped up anyways because they had very positive earnings report. I remember one of my big reasons for getting into them was because I thought they were very undervalued, and they also recently changed their management as well. So that was good. Yeah. I'm real happy with that one.
Yeah, you did well.
I think I would leave both of them for the meantime. If it was up at 20, I should have got out of it when it was at 20. I don't know why I didn't. But there you go. Lesson learned. Okay, moving on then. We have our energy sector. We have Emera Incorporated as our first one. Up is 7.5% is nice, and they're evenly balanced within our portfolio. Oh no, sorry. Excuse me. Sorry, hold on. There we go. There's 3 here. This is our last sector. We have our energy sector where we have 3 shares. Now, the first thing to note here, and I was a bit uncertain of what to do here. This is overweight in our portfolio. This sector is weighing 15%, so it's over a sort of 10% threshold. The first company we have is Emera Incorporated, up by 7.6%. The next company we have is Total Energies, who are up 11.7%. And then the last company we have are Woodside Energy, who are also up 5.5%.
You might want to check that Woodside Energy. I thought it was a negative. But anyway, let's assume it's positive for the moment, all right?
Okay.
Well, in the energy, what's the total? 15%.
Yeah.
If I was selling one, it would definitely be Woodside Energy. It's another Australian share. Just to make sure, I wouldn't sell the other 2, but I'd sell Woodside Energy and get it down to 10. I think 15% is too high for us there.
I would agree. Okay, you stick Woodside on the list, so.
Yeah.
Interesting. Okay, well, going down anyways, you've added a couple more to the list here than I've added. The first one, you added Ryanair, Granda, did you?
Yeah. Well, I was saying we might add to that.
Might add to it. Interesting. Well, anyways, the ones that I wanna add to the watch list will definitely be Adecco, Whitehaven Coal Limited, Tesla, and Banco Santander. With the view of we definitely sell something in Banco Santander. The question would be how much, and then probably cut Tesla, maybe add to Whitehaven Coal Limited, and I don't know what to do with Adecco. I'd maybe leave it for the minute. I'm not sure. That would be my view.
You'd add to Whitehaven Coal?
Yeah, well, there's a lot of blood in the streets. 25% down, We'd have to review the technicals of it, of course, and maybe dive into what's going on there in Australia. But I would be of the opinion, granted, that, buy when there's blood in the streets, even if it's your own. Goes through my head at least once a day.
Yeah.
You wouldn't be of that opinion, no?
Well, of course, I also have this worry about investing in coal,
Yes.
the green agenda and all of that, right?
Yeah.
I don't understand what's happening to Whitehaven coal.
Yeah.
Let's see if the technicalities back these up.
Yeah. Okay, so let me just get this down in the notes here anyways. The first one we have is Ryanair that we would do something to. The next one we have is Adecco.
We might want to take a paid there.
Yeah. The next one we have after that is BASF, you said. Or do you
Yeah,
want to leave
because they haven't said what their the technologies will show. They haven't said what they're going to pay by way of a dividend.
Yeah, which would definitely be alarming for a dividend investing strategy.
Yeah, Tesla definitely.
Absolutely, Tesla. Yeah.
Whitehaven coal because of the size of the loss.
Well, you said Volkswagen as well.
Yeah, because they haven't said what the dividend is either, and they're going through very uncertain times.
Yeah.
So I keep them on the watch list.
Yeah, we should also probably stick Sunoco on the watch list as well as a potential sell of profits or something like that.
Yeah.
Or sorry, I mean sell of initial investment. Where are we?
Well, EDP we said we'd watch. See EDP there?
Oh yeah, here it is. Yeah. Sunoco.
And Sunoco is just it's doing so well. The question is, would you at any stage cash in any of it? It's still quite a modest holding, 5,900.
Well, I'd say probably a lot of that granite is due to the Trump administration coming in saying that they want more oil. So Sunoco are oil distributors, and they're the largest in the States, and they only do in the States. So that's probably because of that. I don't know, will that last though? That might just be a little bit of a, sort of.
And Santander, we certainly have to look and see, should we reduce some of that?
Yeah, maybe CVS we should stick on the list. As one we'll look at.
Yeah.
Bristol Myers Squibb I think is fine.
Yeah, so do I.
CVS
Woodside has done very well, but still only 5,000,
Yeah. And Woodside as well.
Oh, definitely Woodside, I think,
Are you getting tired, Grandad?
Well, I was up at 7 o'clock this morning working on this stuff.
Oh, good, man. Okay. Let me stop sharing my screen. Okay, I think we'll call it there. Thank you very much, everyone, for watching. In the next episode, or the coming episodes, we're going to be reviewing that Excel spreadsheet. We're going to be looking over all the technicals as well. And also how we calculated it. I need to figure out some way of how I can put that Excel spreadsheet in the description so people can download it and use it as a template. So just bear with me for that, folks, because that Excel spreadsheet is great. There was one thing I also wanted to point out. This is the second round of me and Grandad recording this episode this morning, okay? And the reason is because when you're doing it in an Excel spreadsheet like that, you need to be very, very careful of using the live prices, because remember we discussed in a previous episode, there's a lot of ADRs where there's shares listed on not their primary listing, or it's not their primary listing, they're listed on different exchanges, which changes the price and can also really change your decision making going
because
forward.
they might group 5 shares together for an ADR, so it'd be 5 times the price.
Yeah, 5 times the price, and also change your rankings as well. And a ranking is one of the features that Grandad includes in his Excel spreadsheet, which is very, very informative and very intuitive in aiding your decision making, which is something we'll be looking at in the next coming episodes. So, just to finish off, if you haven't already gotten yourself a copy of Grandad's new book, Successful Investing: How to Make Money in the Stock Market from Real Life Experience, make sure you go and get yourself a copy now in the description. And also follow us on social media at The Investment Hound. Any last words, Grandad?
Well, you did actually, bring a couple of shares to the party where we've done very well.
Yes.
So all I can say is this is my beloved grandson, whom I'm well pleased.
Yeah, maybe a bit. Some of them may be a bit fluky. Some of them I was proud of, but that's the game, isn't it? That's the game.
Yeah, that's the game.
Okay, we'll see you in the next episode.
Cheers. Bye-bye.